Finally, loan types. What kind of loan types will you run into in the course of your life and loan amortization? First loan type, simple loan type, might be a T-bill or a treasury bond where you loan, let's say, $25 to Uncle Sam. First treasury bond I ever bought was $25. It would grow to $50. It cost me $25. It grew to $50 over a course of 5 years, and I would simply get a certain rate based on that at the end of 5 years. So these loans are very common. You loan the money, in this case, in a T-bill to the government, and they pay you back over a relatively short period of time. What that time period is determines what rate of return you will get on that investment. Another loan type is an interest-only loan where you only pay interest every period, and you get the principal back at some point in the future. Example of this interest-only loan would be a corporate bond. In this case, let's say it's an Apple bond. You want to buy Apple Inc. bond. You pay Tim Cook $1,000 eventually. He'll receive the money. You'll go through your bond broker, typically, to buy that Apple bond. And you'll pay $1,000 today. You'll get your $1,000 back in 30 years. Typical corporate bond time to maturity. We'll discuss this in the next chapter, Chapter 7. Is typically 30 years. So you give your $1,000 up to the bond broker today. You'll get your $1,000 back at the end of 30 years, and during that time, you'll get some interest paid. That's called a coupon payment, and that coupon will be paid each and every year, same amount each year. That's called an interest-only loan. So a corporate bond is an interest-only loan. And finally, an amortized loan. This will be your mortgage, your home mortgage. You pay some interest and some principal every month. Starts off with high interest and small principal, but the same total amount every month in that amortized loan. Maybe that's $1,000 a month, $10 of principal, $990 of interest. And that reverses in the 360th payment, which is 30 years, times 12 months a year. You'll have $990 of principal and $10 of interest. That's called an amortized loan. Mortgages are this way. Some car loans are amortized. Some car loans are simple interest loans. I just signed up for a car loan, which was a simple interest loan, but they vary. They can be an amortized loan also, where there's a small bit of interest and a large bit of principal, and then that reverses by the end of the term. So home mortgages, car loans, these days car mortgages, they can get very expensive. This concludes session 6. I hope you enjoyed discounted cash flow valuation.